Hey, folks, welcome. This is CNC Realty Group, LoftsNHomes.com. In our client training series, we are going to be with Drew Stiegemeier of Multer Financial, and we are talking about 5 things to know when applying for a mortgage. Hey, Drew, how are you doing this morning?
Doing well, Kyle. Thanks for having me. So let's talk a little bit here about what to know when you're applying for a mortgage. Most people going in for a first-time home buyer really don't realize what goes into it and kind of the best practices for, putting yourself in the best spot when you do apply for a mortgage. The first one is you really need to manage your debt, and that goes more than just, limit what you're spending, but it's understand your debt, understand what goes into it. Easiest way is keep your monthly obligations lower to help you afford the house you want. The rule of thumb is, they always say the rule of threes, it's 3 times your gross income is the house they say you can qualify for. But the hard line is they'll let you spend 45% of your gross income with your new house payment, as well as your current expenditures, which would be credit cards, car payment, and that. So that doesn't even include the power bill for that. So we always say wait to make any large purchases until after you bought your new home. Obviously a car payment's going to have a big impact on the debt to income ratio. You're buying this new house, you're like, hey, we need to get the furniture for it. Another big expenditure that we want to keep off the books. And then keep your credit card debt low. A lot of people don't realize this, but if you can keep your debt at your credit card debt at less than 35% of your available credit, there's no hit to your FICO score. So keep that low. The other thing that's big in our clients' lives now are student loans. Even if they're in deferment, they still impact your debt to income ratio. The guidelines require that 1% of the outstanding balance be counted as your monthly payment. So the example given here, if it's $100,000 you have in student loans, that equates to $1,000 a month payment. So make sure you have steady employment. This is, W-2 jobs are always preferred because of, just the stability of it. And we want to see that you're in your job for 2 years in the same field of work. Your exceptions will include obviously college graduates and members of the military because, their work history can be a little scattered. But, if you're self-employed, you have to have 2 years history of it. And a lot of people, which we understand, you write it off so you don't have to pay the government the taxes. But remember, your gross adjusted income is what we use. So if you're writing off a bunch, it could have a detriment. And remember, if we're going to use any bonus income, commission, anything like that for your income, again, 2 years, you have to have it, or else we only can qualify you on your base income. So it's just something to keep in mind that, yes, while you're getting a bonus and commission, that's not, it may not always be the case that we can use that income. Finally, another one, know your credit, understand it. You're able to get a free credit report each year from the government. A lot of people don't understand or don't know that that's available to them. Literally right here, annualcreditreport.com, or calling that 877 number. You get a free one, and it'll be the one that we pull for your mortgage, so you have a good idea of where it is. Credit Karma and the free credit sites don't always give you a great idea, but the one that you'll get from the government does. Again, I'm going to reiterate this. If you have a high credit card balance, pay it down. If you can get it to go below 35%, you will have a dramatic impact on your credit score. And with that, make your payments on time. Don't miss any payments. That is the worst thing you can do. It stays on. It's a derogatory item. So just make sure you're paying your bills on time. Electronic payment is always preferred because snail mail, we all know what happens with that. A lot of people don't realize that you don't have to have 10, 20% to put down on a house anymore. We can go with low down payment options, little as 1% down, based on the income. But with that, 3% down regardless of your income, especially here in Cook County. The rates are super low, and they actually will give you a break on your mortgage insurance payment if you're a first-time home buyer. All these are stuff, I can help you answer once we talk it back. But, even with gifts count towards that, and they can be used. So you really can come up with none of your own money as long as you do the 3% down program. use a mortgage broker. Obviously, it's good for us. They always say shop around. Well, that's what we do on your behalf. A broker shops around many different banks. I work with 8 of them, personally. It helps you offer up better interest rates, different products that, you may not know, an ARM or, splitting it into a first and second, different mortgage insurance options. Really it helps us find you the best product, the best fit for your situation moving forward. So that's why we always like to recommend using a mortgage broker and let us shop on your behalf. We also have some of the fastest closings in the industry. 30-day closings for condos here in Chicago, that's regular. It's nothing new anymore. And a big thing that we've done here in the last year that we've really focused on, we've removed all these, they're called funding conditions. But now at closing, you just sign, the wire's already there from the bank, and you fund. What used to be a 2.5 hour process is now down to 30 minutes. So it's not that we're sitting around at the title company waiting for that to wrap up. And you can verify our business. We have over 200 5-star reviews, and actually I think we just got our 300th one last week. So I had to update that number, but we do a really good job. Our clients, it speaks to what we do. You can look me up on Zillow as well. All our reviews are very stellar and really support kind of what we do as a company. So just to kind of recap, manage your debt, keep your employment steady, know your credit. That's a very important one. Make sure you utilize that free credit report from the government. Remember, there are low down payment options available for you, and use a mortgage broker. Have them shop around on your behalf and to get you the best product to suit your situation moving forward. So, Kyle, any questions here? I think you had a few from the crowd.
Yeah, Drew, that's great information. Thanks. I know there's a lot of information and quite a few questions coming in online. So from Sally, she's asking, should we have a property identified before getting pre-approved for mortgage?
It's always nice to have a property in mind, and we can use that for kind of a real-life example, but just remember that may not be the property you end up going with. When we talk about pre-qualification for a loan, it's not always what you can afford, it's what are you comfortable making for a monthly payment. And we're happy to run all the figures, and we can show you pretty well what your all-in payment looks like. And especially on a condo, we'll factor in the homeowners association taxes, insurance, principal, and interest. So you'll have a good idea of what the payment looks like. So while you have a property in mind, it may not be the one that fits your budget, but it's not a bad idea to have one when you do talk.
Okay, Drew, I have a question. You mentioned ARM. Can you explain what ARM stands for?
So, Kyle, an ARM is an adjustable rate mortgage. And what this means is that for a certain amount of time, typically 7 years, the interest rate's fixed. But after 7 years, it can move. The interest rate can fluctuate. And it can actually fluctuate as much as 2% over the life of the loan. And, it's really a product that you want to be in for 7 years or less. You don't want to let it get to the adjustment period. So if you're going to hold on to the property after you move out of it, maybe an adjustable rate mortgage is not for you. But if you know that I'm here for 5 years on a contract job, then yeah, your interest rates are going to be a little bit lower. But again, you want to make sure that an adjustable rate mortgage, something happens, whether it's refinance, sell the property, regardless, before it adjusts. Because interest rates right now are historically low. While I'm not I cannot predict the future, there's really only one way for interest rates to go, and we've seen that since the election last year. So if you're in an adjustable rate mortgage, while it is a very good product, it's one that you need to know, towards year 7, it may make sense to either refinance, sell, or, restructure it, sell.
Cool, thanks. Mark247 is online and asking, should I close lines of credit before applying for a mortgage?
You don't necessarily need to close any lines of credit. As we look at it when we talk about pre-qualifications, we may determine that, hey, we need to get rid of a few a few credit card debts to lower our monthly obligations to get us into a property. But, that's something we can visit once we take a look at the credit report, and understand where our debt to income ratio lies. So you don't need to do anything before you talk to, your banker, but just note that that may be something that is asked of you.
Okay, I think it's pronounced Vanya 238. Is there anything different you would advise for refinance of a home?
You need to pay attention to kind of your market conditions around your current home. The best way, like when we talk about refinancing, is you want to have a little bit of equity in your home. And this is something Kyle can help you with, to help determine what your home is worth. And then we can talk about it from a standpoint there. You realize that we can save on mortgage insurance rates if you have mortgage insurance on there. You can get that removed. We can take it down to a lower term. If you think your payment's too high, we can restructure it back to a 30-year to lower it down. There's a lot that goes into it. And again, consult with, myself or Kyle. We'd be happy to talk about, the value of your home versus, what's out for a loan. And then we can determine there the best plan going forward.
Great. Next questions come from Jennifer. What if you have previously collection activity or some late payments on your credit report?
So we won't know the impact that they have until we actually get a copy of your credit report. Some collection items, they'll make you take a minimum payment on that. But ones that they don't is medical collection, and that's one that we see quite a bit. Anymore, we all understand the cost of medical bills, and that's what has gotten quite a few people into collection problems. Now, while we don't have to hit you for any sort of a payment, it does impact your credit score. So, as we get into it, we can take a look and advise on what needs to happen. We also work with credit repair people that can give advice as well to see what we can do to get the score up in a rapid spot if need be. So, once again, it's going to be a case by case, whether there's any collection activity that needs to be paid off currently, or whether we can just get by with the minimum on it.
Okay, we got time for two more questions. Can you still get low down payment mortgage if you have previously bought or sold a home? And that's from Jerry.
Yes, you actually still can. Some programs will want you to wait 3 years from, bought or sold a home. But depending on income limits, one program specifically run by Fannie Mae, you can get by with a low down payment, without having to wait the 3 years. Now, it's income dependent, but, it may be something that you're in a situation we can do. Again, feel free to run the scenario by me, and we can kind of visit it to see what's available for you guys out there for your low down payment. And remember, we're going to do all our work on the front end to ensure there are no problems. We want to be as transparent as possible. But still, at worst case, the minimum you'd have to put down would be 5%. If there's a 3-year waiting period and you can't get to 3%, you still can do 5%, and they will write the loan for you.
And one last question, Drew. What about for LGBT persons or couples? Is there any differences or anything they need to do differently in terms of applying for a mortgage with you guys?
So as far as LGBT and conventional financing, there is no difference. As long as you guys are married, it's treated the same way. It's a joint credit pull, it's a joint application, and even if you're not married, you're engaged, boyfriend, girlfriend, all that, we still can put you on as a co-borrower on the loan. So it works the same way. There is no difference in that. So that makes it nice, and it's a pretty streamlined process moving forward.
Thanks, Drew. That's all the questions we have time for today. And thanks you all for joining us. It's 5 things to know when applying for a mortgage. We've been working with Drew Stiegemeier today, as well as he's been helping to educate our clients at CNC Realty Group, LoftsNHomes.com. So Drew could certainly help you with your mortgage questions for first-time purchases, second-time purchases, refinance. And our brokers at CNC Realty Group, LoftsNHomes.com could help you on the real estate site to locate various types of properties, condos, townhomes, and multifamily residential properties. If you like the presentation today, connect with us on our social media, and you can find the links at LoftsNHomes.com. And also click like and subscribe on YouTube so you could get the updates for all future training, as well as other topics that we will be featuring and make available for our clients. Thanks again, Drew, today for joining us, and everybody else here at CNC Realty Group, LoftsNHomes.com. We look forward to working with you.